History doesn't repeat, but it often rhymes. Despite how much we'd like to think we're so different from the past, we can't escape the fact that we're still humans with the same psychology and behavioral patterns as past generations. Those who have learned from this, with the ups and downs of all the markets, those people have made fortunes.
The 20s had been so prosperous in so many places. People were making fortunes on the stock market. A new plateau of prosperity in this country. And then all of a sudden, poof.
The crash was followed by a depression that spread across the world.
The internet is changing everything it touches.
It's probably one of the biggest socioeconomic changes that's ever hit the planet.
If you don't get on this technology boom, you're going to miss the whole thing.
So please, bring on the recession.
Let's talk about the speed with which we are watching this market deteriorate, down by full 5%.
We're down over 16%, has fallen about 18%.
Down 21%.
Because we're now down 43%.
There have been about a dozen recessions since 1929, and the same principles of those who made millions in each of those ups and downs can be applied to our crypto and NFTs. Once you take that emotion out of it, the euphoria of seeing the prices moon and the sadness of seeing them decline, once you take that emotion out of it, there are some real life lessons to be learned. Now, I want to show you some of these lessons, and I want you to bookmark them somewhere in your brain because, without a doubt, we will see them again. Let's get into it. There are some fundamentals we need to establish before we get into the lessons. Firstly, prices never go up forever. Nothing does. And counter to that, things can't go down forever for legit businesses, that is. Those businesses that intend to continue operations. So for all legit and successful businesses, you get an up and down chart that moves up and to the right with time. That's what history with stocks and even crypto show happens. Now, we can't time the exact bottoms or tops, but throughout history, there are indications when either of those tops or bottoms might be near, whether it's monitoring government policies or economic trends, or the start and potential end of major world events. These can be indicators where you can maximize the effectiveness of your DCA or profit taking. There's even a famous story of Joe Kennedy in 1929. That's the father of former US President John F. Kennedy. A shoeshine boy was giving him some stock tips, and the veteran investor that Kennedy was then decided to sell his stocks in the summer before Black Tuesday. He said, if shoeshine boys are giving stock tips, then it's time to get out of the market. When Kennedy was getting his shoe shined in that summer of 1929, things were near the top, and there were signs. There was a ton of investor speculation, and it would say over speculation. A lot of price to earnings valuations didn't make sense, and kids proclaiming to be experts with their investment tips. If we just fast forward 90 years to 2021 and last year's crypto bull cycle, you had once again a ton of new investors entering this space with heavy speculation. Price to earnings valuations didn't make sense in the form of meme coins worth tens or hundreds of millions that actually did nothing. And you had 16-year-old TikTokers who probably haven't opened up a finance book in their lives giving investment advice.
Many analysts, including myself, believe that Doge has the potential to be equal with Ethereum.
Because in a bull market, everyone looks like an expert. So like I said, history doesn't repeat, but it often rhymes. So let's learn from history and apply it to our digital assets. And let's do that by first listening to one of the most successful investors of all time, Warren Buffett.
One of the most respected investors in America.
The only person who has ever, from scratch, built a company that is in the top 10 of the Fortune 500.
If you're emotional about investment, you're not going to do well. You may have all these feelings about the stock. The stock has no feelings about you.
For the first lesson, let's take a listen to Warren Buffett about 15 to 20 years ago.
It's like most trends. At the beginning, it's driven by fundamentals. And at some point, speculation takes over. You know, it's that old story of what the wise man does in the beginning, the fool does in the end. Any asset class that has a big move that's based initially on fundamentals is going to attract speculative participation at some point, and that speculative participation can become dominant.
History definitely rhymes, doesn't it? Now, Buffett was talking about commodities here, and not too long after, the commodities went through a bit of a decline. We saw the same thing during the Great Crash of 1929. The dot-com bubble was similar, where anything that had a website, people poured money into them. More recently, we have meme coins that don't do anything to create real value that everyone speculates on. Even the meme coins that claim to do honorable things, like charity donations. As Charlie Munger said,
But you know, if you mix raisins with turds, they're still turds.
Those turds eventually die out as well. Here's a clip from the same meeting, and I think it will relate to many.
Once a price history develops that causes people to start looking at an asset that they never looked at before and to get envious of the fact that their neighbor made a lot of money without any apparent effort because he saw this early and so on, that takes over.
You see, the whole crypto space saw a massive influx of new users during last year's bull run. New blood chasing what others had gained simply because they got in earlier, which led to a ton of speculation from the newbies chasing similar gains. Over-speculation creates bubbles. We need to remember that, and we need to learn from history. Now let's take a look at Warren Buffett's 43 lessons for business and life. I have the digital version here. Lesson number 14 states investors should remember that excitement and expenses are their enemies. Now, excitement and demand make the prices go up. In the short to medium term, all else being equal, if you buy in that excitement period, you're overpaying. In today's world, that's when all your favorite YouTubers are talking about a particular collectible or a set of collectibles. Or in the broader crypto space, when public figures begin talking about a particular token or project. Now, my message to those concerned about profits is take profits in the hype. But if you're a hodler with a time horizon of many years, if you're a collector buying what you love, then this doesn't apply to you. But for the many that are looking for profits, take them when they're being hyped. For the many that joined the crypto and NFT space in 2021, this wasn't done nearly enough. Let's take the golden moments, for example. They were up over 3,000%. That's a lot. But people kept holding or buying at that point because of over-speculation. Now, whether it be speculation on another ridiculous price rally or that we would get tickets to Disney World or something like that, which really started from hopium and then spread heavily through speculation in Twitter spaces. Even without the signs of a war or the effects of supply chain shortages from COVID and government rate hikes. Now, there were signs that the overall NFT market was overhyped from this kind of over-speculation. So my message to you all, take profits in the hype. My next lesson is beware of price predictions after a price surge. Now, a part of the issue I see with some of the crazy price predictions was, number one, not grasping the fundamentals I mentioned earlier, plus maybe some confirmation bias. In that up and down cycle, everyone wants to be here. Everyone wants to be at the bottom of a surge because everyone wants to make money, and being right here is the easiest way to do that. In fact, there were signs that we were nearing the top, that we were actually somewhere here. Plus, consider things how bots inflate the prices, which I've mentioned countless times. But if you just think about it, let's go back to those golden moments for example, and some of those comics. They were up over 3,000% over retail. But then we all started hearing about price predictions for even the most speculative comics, questionable comics, predictions that they might reach $1 million. If I could just take a moment to be real with you all, 3,000%, that's a lot. Now, I know that we're always thinking about the handful of events in history, like buying Bitcoin at 5 cents and wanting those gains, but those don't happen over short periods of time. It took Bitcoin over a decade to do that. And those events don't happen as often as we think or hope. I think one of the issues is here in the crypto space, we always hear about getting the financial freedom from the institutions. And while philosophically I kind of agree, that invalidates profits that are not life-changing. You know, a $2,000 profit on a golden moment, it gets people hoping for another 30x because it's not life-changing. People hope, then believe they will get another 30x. Then people start believing they are at a different part of the cycle. And don't get me wrong, I do think many of the tokens out there and some NFTs will recover. I touched on the signals to watch in my last video. So those holding long term and those buying what you love, they're good. But for the rest, let's remember this lesson. Beware of those price predictions at or after a significant price surge. My next lesson here is that the macroeconomic factors rule all markets. Nothing is bear market proof, despite hearing people talking about Omi being some kind of special case. I was firmly against it, and I think we can see why.
Inflation is a real challenge to American families.
Because of Putin's war in Ukraine.
The U.S. could be headed for a recession.
COVID-19.
Coronavirus. This pandemic has sucked.
There's a big difference between being deflationary and having deflationary tokenomics and being bear market proof. We just need to listen to history and not hopium. History shows that the only things that did okay during a bear cycle are either companies that provide savings during difficult times, like what Walmart or what Groupon did during the last recession, or companies that provide escapism, like alcohol or video game companies. Now, in the crypto space, I don't know who would provide this. Maybe the GameFi category, if they can progress into their development fast enough to time with the bottom of this current recession. I'm not sure. Not financial advice. I'm just thinking out loud here. But anyways, my point is the macro dictates all markets, and it happens time and time again. The macro forced companies to miss their earnings, which leads to jobs being lost, which leads to people losing their ability to spend. And remember, money is a big reason for things like divorce and defaults. And divorce and default are the biggest reason people are forced to sell their assets, leading to lower prices. So let's again learn from history. The macro rules the markets. The next lesson here is a critique of advice I hear way too often. We all know the saying, be fearful when others are greedy and greedy when others are fearful. Of the thousands of Warren Buffett quotes, this is the one that is overused. Now, don't get me wrong, it's a great philosophy, but it doesn't need to be used at every opportunity. Following it blindly will just lead to confirmation bias, that every low price stock or dip is a good buy, and that every high price stock or crypto or any increase is a bad buy. You still need to do the work researching and analyzing the real causes and underlying issues. Now, this video and my last one lay out some of my research and analysis of those issues. Yes, the markets are down, but the macro could get worse before it gets better. Now, I want to tie this all together for you now. Now, there's a lot we can learn from the history of finance, economics, and human behavior. The issue I am seeing is things like predictions, they're rooted on hopium and not that history. We stand on the shoulders of giants, and despite the fact that we are in a new space of crypto and NFTs, we're still humans who follow the same patterns and the same cycles over and over. If we don't use that knowledge, we'll make the same mistakes. So here's the game plan. Take this information to stay one step ahead. There are some millionaire real estate investors who, when they see the signs of a peak, they don't buy. They plan the next step. They pay off their debts. They build cash reserves and build their credit scores. So when the market dips, because it always does, they have the ability to buy everything at a discount and get the low interest loans that the banks are desperate to offer. Then when the market does come back up, because it always does, rinse and repeat. We need to do the same thing. So let's remember what we discussed here, because there's one last saying. Fool me once, shame on you.
If fool me, we can't get fooled again.
Yeah, something like that. Thanks so much for watching. Please consider liking, subscribing, and following. I'll see you in the next video.